So welcome and thank you for joining me for the Millionaire Real Estate Investor Workshop. This is a class that was actually created by Gary Keller, who is the founder of Keller Williams Realty. And he wrote this book, The Millionaire Real Estate Investor, as well as many other books. He is a best-selling author. And this particular book is a manual, a blueprint, you could say, for building wealth in real estate investing. So I'm presenting this material to you based on Gary Keller's very valuable information and content from this book, and I'm excited. I think it'll be helpful. These are just some legalities that I have to include in the webinar. Obviously, the results are not guaranteed. I'm bringing the information, and it's up to you to do with it what you will, and take action and get the results. So that's basically what that's about. And a little bit about me. If you don't know me yet, my name's Carey Gatto. I'm a licensed realtor, and I've been working in the full-time in the greater Boston area for 11 plus years now. I came to Boston when I went to Boston College, graduated in 2001, actually had a BA in psychology, and then went on to do film production at Emerson College. And again, been licensed in real estate for over 12 years. Or over 11 years, and I've been with Keller Williams Realty for about 6 years now. It's a great company. If you are not familiar with Keller Williams, their biggest claim to fame is about training. They have extensive training for new and experienced agents, so I've really soaked up a lot of the amazing and valuable information that they've offered me. And I have written a book all about real estate investing called You Can Have It All with Real Estate. It's available on Amazon. It's based on my own experiences as an investor, as well as my clients, as well as a lot of that training that I just mentioned. And it's particularly for people who are starting out in investing or haven't even gotten started yet and don't know how to get their foot in the door. So if you're interested in that, you can grab a copy on Amazon. And as we go into the subject today, the content today, I do want to let it be known that you can feel free to raise your hand or unmute yourself, ask questions, or put questions in the chat. I want to be a resource for you today. That's why I'm doing this, just to, like it says here, help more people be empowered to have financial wealth, and therefore take that piece of stress out of their life so that they can more fully pursue their passions and their purpose in life. For me, that's kind of like my big why I like teaching around real estate investing. And I would invite you to take a moment to think about why you're here today, what has caused you to start, thinking about real estate investing, or review the principles of real estate investing. Maybe you're continuing your journey. And if you want to share, I invite you to put it in the chat. Why are you here today, or what do you hope to learn from today's webinar? All right. So here's what we're going to cover in the workshop today. So first of all, we're going to talk about the possibilities. And included in that section will be some myth understandings, as Gary Keller likes to call them, around real estate investing, maybe some limiting beliefs that a lot of people tend to have in that area. We'll touch on some current statistics in the market here in Massachusetts, and also we'll visit and touch on your big why, because that's important to think about. And then we'll discuss the power of leverage, and this is what really sets real estate investing apart as such a powerful vehicle for building wealth. And I will illustrate how that works and how you are going to be empowered to grow your net worth over time using real estate. And then we will also cover the proven systems that you can implement into your own life and your investing journey to start or continue your real estate investment. Great. So Lorraine shared that she's just looking to learn more. I love that. I am too. I'm always looking to learn more. So good for you. Thank you for being here. it's so good to keep in that learning mindset. Absolutely. All right, so let's start with the real basics. Financial wealth, what is it? What financial wealth really is it's unearned income to finance your life mission without having to work. And the important word there is unearned. If you're constantly trading time for money, then it's almost impossible to become financially wealthy. What we're looking for, what investing represents, is making your money work for you so that you don't have to work for money and keep trading your time. And there's a very good book on this concept called Rich Dad Poor Dad, which basically inspired me to become an investor and a business owner, by Robert Kiyosaki. If you haven't read it yet, highly recommend you grab that book. Yeah, so this is the new model that we're working with. We're not talking about trading time for money over decades and decades for a small pension at retirement, at the end of your life. We're looking to build wealth now so that we can finance a life by design, that we can do what we want. So we have freedom with our time. We have time freedom. So that's really what we're talking about. This is the kind of financial wealth we're looking for. So as I mentioned, there are 8 myth understandings between you and financial wealth. And so I'm going to go through them now, and maybe some of them resonate with you, some of them don't. Feel free to put in the chat which one resonates with you the most. I know a lot of them have definitely resonated with me, and here they are. So number 1, I don't need to be an investor. My job will take care of my financial wealth. But the truth is, you really do need to be an investor. Your job is not your financial wealth. And what I mean by that is you or anybody can have a high income, and yet if your spending habits, if your lifestyle costs is equal to or even greater than your income, then obviously you're not wealthy, right? You're actually going into debt if your spending habits are greater than your income. So, and we've seen this happen with, celebrities and athletes or lottery winners who have all this money, but then they just spend it because they don't have good financial habits. And being an investor, again, going back to what I said earlier, it means that your money is working for you. So this is why we're here. We're learning to be in the mindset of an investor and build net worth, not just make more money, but build net worth. That's the game we're in. All right, and then number 2 is I don't need or want to be financially wealthy. I'm happy with what I have. And Gary says very bluntly, you need to open your eyes. You do need and want to be financially wealthy. It occurred to me recently that being wealthy is actually a form of self-care. It's actually a very high form of self-care, because just like everyone's talking about self-care right now. They say put on your own mask before you put on someone else's. You got to take care of yourself so that you can more generously give to others and take care of others. And it's the same thing with being wealthy. If you're strapped for cash or perpetually broke or stressed about money, then you're not really going to be able to help as many people the way you really want to. What if someone in your family had a health crisis and they needed $50,000 for some kind of medical operation, right? These things happen all the time. What if you could just write that check without even blinking an eyelash and be able to give that to them? Or if it's, the next hurricane or natural disaster happens, what if you were able to write a check for $100,000 and just give that to the victims of that disaster, that crisis? Filling yourself up, taking care of your own financial needs so you can live in abundance and then flow out from there to your community, your family, your friends. That's an amazing goal. So I would argue it's like a form of self-care to wipe the money worry off your plate and then be able to live in a more generous way. Number 3, it doesn't matter if or want I need it, I just can't do it. Okay, well, we know that's not true, right? Even though a lot of us think that in the back of our minds, it's a limiting belief. But if you look around, there's so many rag to riches stories in real estate. In fact, in the beginning of this book, Gary Keller, this book, The Millionaire Real Estate Investor, he talks about a story of the first millionaire in the US. The first millionaire in the US was an immigrant who came over with, only the clothes on his back. I forget which country he was from, but he came over with only the clothes on his back, and he had like a few dollars to his name when he came to the US. And he landed here, and he pulled himself up by his bootstraps and, worked really hard and was able to invest in real estate, and from there build up a fortune, which this was a couple hundred years ago or whatever it was, 100 years ago. It was a lot of money back then. So, and we hear stories of this all the time, people who have nothing and then they find a way to get in the door and make that first investment. And then from there, they just build and build and build. So if they can do it, so can you, so can I. Real estate investing really is accessible to anyone. And again, you can't predict what you can or can't do until you try, obviously. That's what we tell our kids, right? So it's true for us too. So 5 more investing myths. Myth number 1, investing is complicated. But investing is really only as complicated as you make it. And it all comes down to, time is money, and the compound effect, a little bit over time, consistent action amounts to a lot over time. So it's not complicated. There's a few rules of thumb to pay attention to, and we're going to go over some of that today. And then myth number 2, the best investments require knowledge most people don't have. The truth is, your best investments will always be in areas you can or already understand. And that's another reason I really like real estate, because everybody inherently kind of understands real estate. Why? Because we live in houses. We have lived in houses all our lives. And we just have kind of like, it's common sense. Like this, it's, we're either renting or paying a mortgage. So, it makes sense to invest in houses because everybody kind of like gets it, and has like a common sense for it. And you can learn the market super quickly. You can go to open houses, you can look on Zillow. The internet has so many options for learning the market, and you can connect with your local realtor. You can connect with investment groups. There's so many ways that you can get into this knowledge and into the market and into networking, and get a really good grip on it. And then number 3, this is my favorite one. Investing is risky. I'll lose my money. This is so untrue, and yet I hear it all the time. To me, not investing is the biggest risk that you can take. Especially, we've seen the recent inflation, how that's just made at the cost of everything soar. If you're not investing, then your money is just sitting in your bank account losing value, right? It's just losing value day by day by day. But if you're investing, then you can at least balance out the inflation, and ideally you can actually beat the inflation. So you're actually losing money by not investing. Investing by definition is not risky. It's not a gamble. It's making smart, predictable moves toward a future outcome. And real estate's the most repeatable and scalable investing vehicle that there is. More people have become millionaires and become wealthy through real estate than through any other investing vehicle. Very highly repeatable. Number 4, successful investors are able to time the market. No. Nobody can time the market. Nobody can. I mean, there are experts galore, but no matter what, they're all wrong half of the time. Nobody can time the market. But in successful investing, the timing finds you. And what we're talking about today is actually long-term buy and hold, long-term investing. I'm not talking about flipping. I'm not talking about wholesaling. I'm not talking about short-term, like make a quick buck type of investing. No, because that's more speculative. I'm talking about the long-term buy and hold game, which is what has made people wealthy, more people wealthy than any other vehicle. So the timing finds you. And one of the favorite sayings, the Chinese proverbs is, the best time to invest was 20 years ago, but the second best time is today. There's really never a bad time to start investing. And then lastly, all the good investments are taken. But the truth is, every market has its share of good investments. And I can definitely vouch for that. I started my career in a very bad market, in a buyer's market, 2010, and I've seen that change pretty drastically. But in every single market, there's always ways that you can make it work for you. All right. Any questions so far? And if you do have a question, feel free to put it in the chat or raise your hand, and I'll try to get to it. So now just a quick glance at the market. So these were the experts' home price forecasts for this year. We are coming off of 2 years of double-digit appreciation in the market, and everybody was wondering, is this going to continue? Is this a bubble? And what's going to happen next? Well, these were some of the predictions for this year, and some people thought that it would drop to 2.8. That was actually the National Association of Realtors prediction. They thought, well, this can't continue this high, so I'm going to say it's going to taper off. And some Fannie Mae went as high as 7.4%. So on average, the experts were saying about 5.1% appreciation. But none of them that were surveyed said that this is a bubble and the prices are actually going to drop. They said appreciation would slow down, but they said it would keep increasing, it wouldn't actually decrease. And so far, here we are about halfway through the year. And so far, this is pretty much proven correct. If you take the average, 5.1%. Year over year in Massachusetts, the average sale price has gone up 10 to 15% year over year, depending on if you're talking about single families, condos, or multifamilies. So on average, across the board, about 12.5%. So some of that happened the end of last year, and some of that happened the beginning of this year. So I would say, 5, 6, 7% is probably about right so far this year. We have not seen a bubble. I don't think we're going to see a bubble because the demand is still really high and the inventory doesn't show any signs of exploding. Back in 2007, there were a huge wave of foreclosures, which glutted the market. And that was because of a lot of bad mortgages that were written for consumers that couldn't afford to actually pay those mortgages. They weren't well qualified. And so that's what caused the oversupply of inventory that then caused the housing market to crash, because it's all supply and demand. Too much supply means that now prices go down, same as in any market. But in this market, we don't have that problem of bad mortgages because the whole mortgage industry has had a complete revamping since then to prevent that from happening again. And so we don't have foreclosures today, really. In fact, homeowners have more equity today than they've almost ever had. And so there's no reason for anyone to foreclose. If they couldn't afford their mortgage, they could sell. They'd be sitting on a pile of equity. They're not underwater. So that's why we're not predicting a housing crash. We're not saying this is a bubble. The appreciation is slowing down because the interest rates went up, right? So that's affecting the demand on that end, but we don't have that huge oversupply of inventory. And so that's what we're seeing in the market today in Massachusetts. And it's pretty consistent across the board. In fact, in Massachusetts, these are national numbers, and in Massachusetts, the appreciation's a little bit higher than the national average. All right. And then discovering your big why. I think it's important to really think on this. Why is it important to you to invest? what will it mean for you in your life specifically? And this is something that can change and evolve too. I know when I first started out, it was really about my kids, taking care of my kids, giving them the best life that I possibly could. And then from there, it actually expanded. And I began to think about how money, wealth can help a person self-actualize, can help them move past just surviving to thriving in the world and following their passion and their purpose, like I talked about earlier. And I wanted that for myself, and I also wanted it for other people. And I wanted to help more people see the potential and the possibility in real estate investing. So that's where my big why is now. So what is it for you? What really gets you inspired? What gets you emotional? Because your big why should be something that's meaningful to you specifically. We're not just doing this to have a nice big number in our bank account. There's a real reason, a meaningful reason behind it. So I invite you to think on that, meditate on it, journal on it, and really discover that. And because that will inspire you to take action. And then from there, once you know your big why, you then can you can work backwards and get really specific about your goals, and then your models, and then your habits. And the word big is in there because we don't want to live a small life, right? We only have one life to live. We want to make it as big as we can, because if we make small goals, we're going to only have small results. So why not make the biggest goals that you can and shoot for them? And you know what? If you don't reach your biggest, craziest goals, you'll still have done really well, even if you only land halfway. So think about your big goals. Think about what's something so crazy that people would laugh at. That's where we want to be as far as your goals. And and let them fulfill your big why. Let them be connected to that emotion, that meaning that you have. And then from there, we want to design big models, the systems and strategies for reaching those big goals. Because again, real estate is very concrete, very repeatable, very scalable. There are specific ways that are not so hard to figure out to achieve those goals that you have. And then what are the big habits, the consistent actions and right choices that come from following big models? You can actually incorporate them into your life, and with consistency over time, you will see results. All right. So now we're going to talk a little bit about specifically real estate, why it's so powerful. What sets real estate apart from other investment opportunities? And there are unique propositions of investing in contrast to stocks, mutual funds, and money markets that make real estate special. Number one, real property is an able investment, and the value never goes to zero. There's always inherent value in a piece of land. Yes, it can fluctuate. Yes, markets can go up and down, but there's always going to be inherent value in that land. And then number two is that purchasing real property can be leveraged, meaning it can be financed. You can get a mortgage on it, which means that you can bring just a portion of the cost of the piece of property, the down payment, and then borrow the rest so that your money is highly leveraged. And we're going to talk more about that in a moment. But here are some other aspects of real estate that make it unique. So it's accessible. Anyone can buy real estate. You don't have to be a stock market expert, or have really any particular expertise. It's available for anyone to buy and get into. Appreciable, it increases in time or in value over time. Over the long term, generally it appreciates. It's rentable. And that means you can get cash flow, right? You're making money while you're sleeping. It's improvable. So you could buy a fixer-upper. You could create value, create sweat equity. more than the money you're actually putting into it. That's sweat equity. And then it's deductible, depreciable, and deferrable, which are great tax benefits. Investors love those. And it's stable relative to stocks and other investments. It's pretty stable. It's slow to rise, slow to fall most of the time. Yes, I know there was a pretty sudden crash back in 07, but I already mentioned why that happened. That was an anomaly. Pretty much all the time, it's very slow to rise and slow to fall. And they're predictors of when that will happen. And it's livable. It's shelter in more ways than one. So, you or a family member could move into your investment property, or you might make your home an investment property. And now I'm just going to illustrate exactly why leverage is such a significant aspect and such a powerful aspect of real estate. So this table is comparing stocks, mutual funds, and money markets to an investment property. Okay. And if you wanted to have control over $100,000 and $100,000 asset in any one of these categories, with stocks, you'd have to bring $100,000. It's a 1-to-1 ratio to have control of $100,000 worth of stock, right? Mutual funds, same thing. It's a 1-to-1 ratio. And money market, same thing, $100,000 cash, boom. However, with an investment property, you have leverage. So to control a $100,000 investment property, you only need to bring $25,000. And by the way, that's if you don't live in the property. If you're living in one unit of the property, you can do lower. You can do a lower down payment, maybe 5 or 10%, or possibly even 3.5% if you're living in the property as an owner occupant and renting out other units. But let's just go with the $25,000 example right now. So you're only putting down a quarter of the actual cost of the property. Then carrying costs in stocks, 1 to 4%, depending on exactly the arrangement you have. If you're working with a broker, whatever it is. Mutual funds, similar, 1 to 4%. Money market, not really anything to consider there. And then with your investment property, your carrying costs, including your mortgage, are going to be offset by the rental income. Okay, so not only do you not have carrying costs, because they're offset, but you also have a cash flow from them. Other costs, 0 for stocks, mutual funds, and money market. Investment property, yes, there'll be other costs. You have maintenance, you're probably paying for water and sewer as a landlord, and you want to factor in a certain percentage for vacancy, 10% maybe, just in case you have a unit that's not being rented for any particular time. But again, any costs should be offset by the mortgage. Okay. And then annual income. So stocks, on average, 8% is considered a good number. Mutual funds, about 10%. Money market, it's lower return, so 2% would be considered decent. And for investment property, in a healthy, stable market, 5% is the average. We've seen much greater than that lately, but 5% on average is the appreciation. Okay, so far it doesn't seem like it's a great improvement upon the other investments. But then other income. Okay, so stock, mutual funds, and money market, there's no other income. It's just the appreciation factor. But then for investment property, you have that rent, you have that cash flow, which the other investments don't have. And that could vary. It could just be $100 a month, or it could be $1,000 or $2,000, and it will vary over time, right? But your cash flow is something that's additional to just the appreciation. So then your adjusted return on investment, and this is taking into account the income every year minus the carrying costs, 4 to 7% for stocks, 6 to 9% for mutual funds, and 2% for money market. However, for your investment property, it's 20%. The reason for that is the leverage, because you're calculating your return on investment according to the $25,000 that you put in, because return on investment is calculated using the cash you brought to the table. So because it's so much lower, because you're using a mortgage, you get a much higher return. The ratio is much higher. So it's 5% of $100,000, which is 20%. Your potential loss for stocks, your stocks could go to zero, right? That's the potential. They could completely go to zero, the bottom out. Mutual funds, same thing. Money market, no, that's a low risk, low return investment. So you don't really have potential loss with that one. The investment property, I mean, if things went terribly wrong, it could go down 40%. That's not likely, but it could happen. But again, you still have that inherent value of the land itself, even if the whole property were to fall down. So, so basically leverage is using other people's money, banks, mortgage companies, and owner financiers to make money, and it multiplies your profit. Appreciation and rent are based on the total value of the property, but your return on investment is calculated by the money invested. And that's why, you're using the 25% or $25,000. And here's the calculation. Assuming the property went up 5% year over year, your appreciation equals $5,000, and that equals 20% of your initial investment. So to make the same money in a mutual fund yielding 10% with no costs, you would have to have $250,000 in cash. That's a lot harder to come up with than the $25,000. So that's why looking at in terms of ROI, real estate is so much more accessible than these other investment vehicles, because you have the leverage. You have the ability to borrow other people's money and make money with it, which is a beautiful thing. Any questions? I'll move on. Great. Okay. So this is a diagram straight from the book, and it's basically two ways of looking at money. And one is the blue, represented by the blue on top, is where money works for you. This is the investment mindset. So when you get money into your accounts, into your household, first you put it toward capital. That's like the base of your pyramid at the bottom, where you want to put the majority of your money, or as much as you can. You go to capital, meaning you invest. Cash flow should come from your capital, because your money is working for you. So it's creating more money. So it's building on the capital, right? And then the cash that you have left over, or the cash that's being generated, you can either reinvest that, so it becomes capital, or you can choose to consume. It's your discretionary income. But that's the tip. That's the smallest portion of your available funds, right? Whereas most people in America do it backwards. They're consuming first. So they take their paycheck and they spend it on whatever it is. They were constantly being marketed to and told that we need X, Y, and Z to be happy. So the money gets spent. And they might have a nice car and they might have a great house, but what are they investing? Are they leaving just the leftover shreds of the money to their investments? Or are they investing anything at all, right? So while things might look good on the outside, I'd rather drive a crappy car and being investing the majority of my money, right? And that's where, like Warren Buffett, that's his mindset. He doesn't think about a dollar in terms of what he can buy with it today. He thinks of it in terms of what he can buy if he were to invest that money for 20 years. And then you're like, well, I don't want to spend that dollar. I'm going to hold on to it. I'm going to invest it and make it work for me. So this is a way that I encourage you to think about money going forward. And it's a good reminder. It's a good reminder for me too. So this chart shows very clearly the power of leverage over time. Again, buy and hold, long-term investing. This is why it's so powerful, because you're buying a property at market value. I mean, it's great if you can get it under market value, but even if you get it at market value, this is what happens. You have a little bit of equity. You're putting a fraction of the cost down in cash. So you have a little bit of equity there. And you have all this debt. But over time, what happens is the property value increases and you're paying down the debt every month. Oh, and by the way, it's not you paying it down, it's your tenants paying it down. So your debt gradually decreases and your equity gradually increases with the market value. And at some point, you've paid it all off and you have this huge piece of equity that you can either sell or refinance at that point. And comparing that to the 25,000 or whatever it was that you brought in the beginning, your ROI is really huge because you didn't have to pay down the debt. You didn't have to build the equity. You didn't have to work for that. It just happened in the background while you were sleeping. So that's part one. That's the financial model part one. And this is financial model part two, cash flow growth, because at the same time that property values are increasing, so is rent, right? And if you're the landlord, then you're the beneficiary of that. So your rent continually, gradually goes up, keeps up with the market. You don't want to be overpriced for rent, but you want to be in line with the market. And so your cash flow increases. Again, your tenants are paying off the debt every month through the rent, and the debt will stay the same because it's a fixed payment. So you've locked in your fixed 30-year mortgage or 15-year mortgage, whatever it might be, and your cash flow increases every time the rent increases. And eventually your debt will be paid off and it will all be cash flow. So you see the two ways that it's working for you, the leverage. This is why real estate is so awesome. So why do people invest in real estate? Well, again, return on investment, less out of pocket for more in pocket, tax write-offs. They grow their net worth through equity. And it's almost like a forced savings. I don't know about you, but I'm actually terrible at saving money. If it's in my account and I see it there, I'm like, oh, I can just take it out this one time. I really need this thing. I really want to take a vacation. But if it's in a property, I'm not going to liquidate the property to take a vacation. It's wrapped up in a property. I'm not going to sell my property for no good reason. So it's like forced savings, and it's very effective for college savings. Thanks, Lorraine. I'm glad I'm not the only one, right? It's good for me to have my out of sight, out of mind, right? And yeah, so it's like forced savings. And if you think about it, if you're saving for college or anything else, you're paying for college 25 cents on the dollar because you're only paying that 25%, but you're getting back all the equity at the end of the day, 10, 20 years, 30 years, and you're getting the cash flow. So there's no better method of investing your money, bottom line, okay? So here are just some of the tax write-offs. I'm not a CPA, so I would definitely recommend and refer you to a CPA. But here are some of the things that could be tax write-offs for you too. And again, that's huge. Investors always are looking to save money on taxes. So proven systems, all right? So if you're just getting into real estate, you might be thinking, well, what kind of property am I looking to buy? And there's so many options. And there's things to consider. There's pros and cons for each. Condominiums, lower price generally. More amenities potentially. You have to consider HOA fees, condo fees, but also those HOA fees are helping to pay for a lot of the exterior maintenance. So that might be a good thing, you know? So it's just, you need to have a good spreadsheet. And if that's something you're interested in, I can share mine with you. I can email it to you, and that will help you analyze the numbers and make sure that you're factoring everything in, that you're not forgetting anything when you're running an opportunity through, through the numbers. Single family home, there are some pros with it. I mean, it's easiest to resell because most people are always looking for single family homes, and therefore more appreciation potentially. And then again, there's only one unit to generate income. So if it's vacant, that's 100% loss of income. Duplexes are really nice because you have 2 units. So, there's not 100% vacancy if your one tenant leaves. And yet they're not as expensive as a 3 or 4 family. They're often close to single family homes in nice neighborhoods with single family homes. And you have potential for more cash flow than single family homes. And then you could go up to the 3-4 unit or higher. And obviously with there, that's a way to scale. It's probably not going to be your first time out, although I really encourage clients to house hack. And I do it myself. Live in one unit and rent out the others. And that way you get the advantage of the lower down payment, and you get the rental income offsetting your own housing costs, so that it frees up more of your income, more of your money to invest. Great way to start out. So question is, which do you think is the best type of property for owner occupied investments? I think the duplex, but also the 3 family. You have more potential for a cash flow with a 3 family, depending on the market that you're buying in. With a duplex, you probably, at least in this area, Greater Boston, you probably won't get a cash flow if you're house hacking a duplex, at least not right away. But 5 years down the line, when rents have gone up, yeah, you might get a cash flow in a duplex. But you can offset your own mortgage and your own housing costs, owning a duplex in this area or pretty close to it, right? So I would highly recommend that, and I talk about that a lot in my book, or I can talk to you more offline about ways to do that and my experience with that. Looking at house hack, big issue is I can only do small down payment, which means my mortgage payment is going to be high and maybe more than what the rent for the other tenants is. Advice. Yeah, I need to know more, like where you're looking and things like that, what your goals are. Maybe we can talk offline. I would love to consult with you on that, just so that I can more specifically help you. Absolutely. Yeah. Great question. I love that you're thinking that way. I wish more people would. It's so smart. So yeah, it definitely depends on the area. Definitely. It's like the biggest factor. Can't move my chat box out of the way and see what I'm doing here. Okay. So first of all, as far as the proven systems go, you need to know how to identify a deal. And that's kind of what you're talking about here. It's like, how do I know what is a good deal? I will send out my, like I said, my spreadsheet to you guys, so you can easily run through the numbers on any specific property. You can analyze any specific property very quickly. And they say to do that like 50 to 100 times, and then you'll really know what a good deal is. Once you've done a practice run, do one a day, maybe for like a couple months, and you'll really have a good sense of what is a good deal. And you can try it with different properties in different areas, in different markets, and compare rents to, you can get in different markets to the sale prices in different markets. And you'll start to learn where you can find opportunities. And then you can make deals. That's a really good system, and it's a doable way of learning your market. So mortgages, one of the first people you're going to want to talk to is the mortgage broker. And it could be a broker, it could be a bank. Brokers have access to many products. Banks typically have access to just their own products. But yeah, you want to, even if you're not quite ready yet, it's really helpful to talk to your mortgage person and start to prepare yourself. And they may have tips and advice for getting to a pre-approval in a shorter amount of time, so you can, take action. So basically, just connect with somebody. I can recommend my person to you, or you can go with someone that you know already. But connect with somebody and just find out what you can do in the next 6 months or a year to further yourself along toward being your goals, toward being able to invest in your next property, and what that would look like for you. Then again, do you want to hire a professional property management company? Do you want to self-manage? If you're just starting out, I would recommend self-managing for now. But if you're really not handy, or you just don't want to deal with tenants, I have an excellent property manager locally who deals with smaller landlords, like 1 or 2 units, that I highly recommend. And I can connect you with him. His name is Jamie Thompson Realty. And again, it is a cost, but you factor it in, and you just have to find the right situation where those costs are covered. So don't be scared of getting help. It's there, it's available, and it's smart. It's smart to do that because you're not looking to take on a job. You're looking to have passive income, right? So either self-manage to begin with, or don't be shy about talking to a property manager too. So next steps, I highly recommend picking up a copy of the Millionaire Real Estate Investor book for yourself to refer to and study. Talk to your mortgage professional, possibly talk to a financial professional, and ideally someone that is well-versed in real estate, or at least is open to working with real estate investors, because some of them aren't. Some of them only want you to buy stocks, just FYI. So make sure you're working with someone who understands and encourages, the power of real estate investing. And then I would love to get together. I would love to talk. I hope you can tell that I'm really passionate about this topic, and I would love to support you any way that I can. And just even, again, walking through your goals, helping you discern which markets might work for you or which strategies might be best for you. So reach out. My information is right here. And I will, as I mentioned, I will also email you, so you can also respond to that email. And we can book a time to chat. So any other questions right now? Okay. Yeah, well, I hope this was helpful. I hope that it inspired you to take a small action. Perfect, Lorraine. Thank you. I look forward to it. For me as an investor, that's, I always like to keep plugged in and keep in that investing mindset. So whether it's your first foray into investing, or you have some experience, just keep staying tuned in, and that will help us all move forward. So thank you so much for joining. I really appreciate it, and look forward to supporting you in the future. Take care. Thank you so much.